Hey, I'm Mike Ferrossi for Super Loans, and this might be the second installment in a series. The last video we put out was all about if you can buy a home or refinance a home with bad credit. That was one of my favorite things to talk about, and so is this. Today, we're talking about how much home you can afford and how that's not the number that you should concern yourself with. Quick background, I've been in the mortgage industry for the last 15 plus years, and I've seen some people get in trouble when they buy their house, mainly because they think they can afford what the bank qualifies them for. We gotta make something really, really clear here. It's very common for mortgage banks to qualify someone for more than they can actually afford. And we can look at this fact and explain it really easily without popping up all sorts of math and numbers on the screen. Let's just talk some common sense here for a minute. Now, when a lender qualifies you for a loan, they use something called a debt-to-income ratio. There's other factors taken into account as well, but this DTI is the basis for your income qualification, basically to see if you can afford the monthly payment that you're applying for. A debt-to-income ratio is a simple comparison between how much money you make versus how much money you pay out on a monthly basis. But the calculation might be a little flawed as it pertains to actual real-life day-to-day living. See, the debt-to-income ratio is calculated using your pre-tax income or your gross income. And they compare that to all of the monthly payments that you're obligated to make based on what shows up on your credit report. Then they add in the mortgage payment that you're applying for and see if the ratio meets the qualifications or the requirements. Typically, that ratio needs to be less than 50%. 43% on some loan programs, but typically you're looking at a 50% maximum debt to income ratio. So if no more than 50 of every 100 pre-tax dollars you make is spent on credit debts and the new house payment, then you'd qualify. And lots of people think that this means that they can afford that payment, reliably be able to make that payment every single month in real life. But real life works a little bit differently, does it? Yeah, we don't get a paycheck for the dollar amount that we make pre-tax. No, we have to pay for taxes. Sometimes we have to pay for insurance. Maybe you're sticking a little bit into a retirement account. Your net paycheck is going to be notably lower than your gross earnings. And that applies for everybody in this country. So we're starting off a little bit shaky. The lender's qualifying you based on a gross income number that you never ever will see on a paycheck. Follow that up with the monthly payment amount that they're calculating this ratio based off of. Well, these are the payments you're obligated to make. You know, credit card payments, car payments, things that show up on your credit report. But you know what doesn't show up on your credit report? Your cell phone payment, your utility payments for gas, electric, water, trash. Those things don't show up on a credit report. Any streaming services that you subscribe to, Netflix, Hulu, Apple TV Plus, Disney Plus, Paramount Plus, HBO Max, all the pluses and the maxes that ding your checking account every single month, that doesn't show up on your credit report either. And don't forget about your day-to-day expenses, things like gas, which shoot, it's March of 2022 as I record this. Gas is a notable expense. The prices just keep going up. And that's something that's kind of ever changing depending on how much you drive and what kind of car you drive. I understand that all of this can get complex and complicated, and it's hard to address it in a video like this because it's different for every single person. This is what makes personal budgeting so important when you're about to buy a house, especially if you're a first-time buyer looking to buy your first house. You really should take the time, effort, and energy. I know it can be a pain in the butt, and a lot of us don't like thinking about money this hard and for this long. But if you can put together a solid, accurate personal budget for yourself so you can actually see all the money that you have coming in and going out, you know, your net pay, which is the amount on your paycheck, all the money you have going out, and the anticipated money you'd have going out after purchasing the home, like all those utility bill payments and things like that, and include things like food, how much you spend a month on eating out, going to the grocery store, entertainment, if you like going to the movies or splurging on an activity now and again. Don't forget those things either, because they're not gonna forget you. Your personal budget is going to paint a much different picture than a simple lender's debt to income ratio calculation. That personal budget might show you that just because you can be approved for a certain amount doesn't mean you want to spend that certain amount. Maybe this is going to be a little bit more comfortable for you and set you up for long-term success. So I see the Google searches, I see the YouTube searches, I hear the questions. I just want to find out how much I can afford. Please, don't forget, after you find out how much you can afford, it's up to you to figure out how much you want to afford. That's the most important thing. Thanks for watching. I appreciate you being here and being open to this little candid heart-to-heart about one of the most important mortgage topics I think is not discussed nearly enough. If you do want to see that other video that I talked about in the open about if you can buy a house or qualify for a mortgage refinance of any kind, really, with bad credit, go ahead and check out that video right over here. And if you want to get pre-approved so you can start your house hunting, or if you're in the market for a refinance, check us out at superloans.com, because at Superloans, great rates have never been so simple. We'll talk to you soon.